I hope you're doing well. I've got a lot of stories to go over with you today. And as I'm reading them, I want you to think about where we are as an economy now. And as the information about the bonds, corporate debt, all of this stuff that's happening right now, where are we going to be in 2024? Do you believe that 2024 is going to be a stronger year in the economy, or is the economy going to be weaker? Type 1 if you think it's going to be stronger, type 2 if you think it's going to be weaker. And the reason why, and I really want you to put your thoughts down below, because there are going to be people that have never had any kind of education when it comes to finance that are going to be reading your comments. And it's time to wake the American people up. As a matter of fact, wake the world up. Europe's already in collapse. The BRICS are expanding even more. They're separating from the US. There is more and more trade going on. What is it right now? 1 in 5 barrels of oil right now worldwide are traded outside of the US dollar. To some people, that's not a big deal. To me, it is. Because that is going to change our way of life. Do I agree with our way of life, the way that our economy has gotten big? I do not agree with that. But I believe a lot of innocent people are going to be caught in an economic collapse. Over the next couple of years, they are going to become very, very dependent on the government, and they're going to be broke. And I want to stop that. All right, so here we go. We're going to dive right in. Also, real quick reminder, this is the last 2 days that the real estate crash course will ever be available for 80% off. It's $199 below if you want to take part and start taking action now to get ready for this real estate crash and how you're going to make money. All right, the first story is entitled U.S. Treasuries. U.S. Treasuries sell $40 billion of 7-year notes at a high yield of 3.859%. Now, first I have to ask you, why would it be a high yield? Why would that matter? It's because there are fewer buyers coming in. Check this out. U.S. Treasury auction of 7-year notes. It says the WI level at the time of the auction was 3.835%. High yield, 3.859%. So they had to offer a little bit more as the day went on because there were no buyers showing up. The tail was a positive 2.4 basis points. Now it says not a particularly strong auction. Rick Santelli on CNBC gave him a grade of D+. Now think about this. Rick Santelli is having to run cover right now and give the most positive side possible. I mean, think about this. Oh, it wasn't the best auction. Yeah, it was horrible. Anytime the government needs money and they're going out, it's getting hot, sorry. They're going out and they're having to raise money, and they actually have to raise rates. They have to actually raise rates in the middle of the auction because nobody's showing up. That's very bad. That's not good. And I want people to understand this. As the Federal Reserve says, we're going to pencil in a couple of rate cuts. At the same time, I said you have to watch the bond market. The bond market is going to tell you the truth about what's going on in the economy. And the truth is, many investors do not want to lock up their money for 5 years. They don't want to lock it up for 7. They don't even want to lock it up for 10 because they know that the Fed still has not gotten on top of inflation. And if they actually do lower rates, it's only going to be for political pressure for just a short period of time, and it's going to take off again. Why? Because if they lower rates, it's going to bring inflation even hotter than it is. Remember, inflation, the narrative, the official narrative, which I believe is a total lie. They say it's what, 3%, 3.2% core CPI, I believe. I'm going off of memory. Now think about this. Think about this. We're way outside of the 2% Fed mandate. And they're talking, oh, we're going to slow things down. Well, it is because the economy is crashing. But we haven't seen a high enough unemployment rate yet for them to justify the cuts, okay? That is the truth. That's what you're not being told. Now, it says U.S. stocks dipped a little bit after the report, but bounced back. Major indices are still up marginally. This is why. The S&P, the Dow, they're all up because people are starved for yield, and they are betting on stocks. They're betting on stocks that have PE ratios that are so out of whack. We haven't seen these ratios since the dot-com bubble. Companies that sit there and they go, hey, we've got, sorry, it's too bright. We've got all these great earnings. We've got all this. It's on fewer sales, and the only reason they have a profit margin right now is because they're firing a bunch of their employees. This is a zombie stock market. Please understand how serious this is. And think about the greater implications for the stock market and the real estate market. Also, real quick, this is Real Estate Ninja, not Economic Ninja channel. If you haven't subscribed, please click the subscribe button. I bring tons of news stories on this channel. All right, so it says, overall, U.S. yields are at record, I hate the way they write this, sorry. I'll read it word for word. Overall, U.S. yields are at record higher across the board. That doesn't even make sense the way they wrote it, sorry. The 2-year is at 4.2%, which is up 3.9 basis points. The 10-year, 3.846, which is up a positive 5.7 basis points. And 30-year, 3.9%, up 4.2. It says the Euro USD is trading to new lows and approaches is one, man, I swear they're doing voice to text with these stories these days. And approaches is 100-hour it's supposed to be 100-hour moving average at 110. We are at a point where the European Union is completely collapsing, and you're going to see it get worse and worse. And I've told you this before, we will follow the European collapse between 6 to 12 weeks because we're so closely tied. Now, let's dive into the next story. This is out of Reuters. New York Fed inflows to reverse repo facility surge, hitting 1.018 trillion. Okay, I want to remind you, to everybody that thinks the economy is not collapsing, the Federal Reserve is bailing out the banks. They've been doing it for over a year. They have hit $1.018 trillion so that you believe that your bank is safe, okay? Type 3, if you agree, it's a big deal. And type 4, if you think anyone that doesn't think it's a big deal is a moron. And I'm saying that seriously because, see, you don't see it, but I get to read the comments, right? And about 1% of the comments come from a couple of morons. And they have no concept of how finances work. They think that crashes come overnight. They don't do that. So right now, you have faith and confidence in a system that has been built up and held up by over $1 trillion in a little over a year because everything is crashing. It's insane what's going on. And actually, it's longer than a year, so sorry, I misspoke. So it says here, New York, out of New York, the Federal Reserve Bank of New York said on Friday it accepted 1.018 trillion at its overnight reverse repo facility. Oh yeah, sorry, that was one night. I'm apologizing. As inflows to the central bank liquidity facility surged on the final trading day of the year. Now, I've got another couple stories of what's going on because the interbank lending rate is spiking right now. They're saying, don't worry, this is totally normal. It says Friday's inflows were expected to jump and were well above the 829 billion seen on Thursday. Oh, that's nice. It only took 829 billion on Thursday to keep the banks going, but Friday it took 1 trillion. Okay, copy. All right. Just please contemplate. But now, when I say a trillion over the last year, when you start looking at the amount available and it's tapering off, it's in the trillions. It's a big deal. So it said the Fed's reverse repo facility exists to put a floor underneath short-term interest rates and is a key tool in the Fed's efforts to influence the economy to achieve its employment and inflation mandates. The facility has seen big inflows over the recent years amid strong Fed stimulus work and peaked at a record 2.6 trillion on December 30th of 2022. Now let me explain the end of the year stuff that we're talking about. Sorry, and you remember, I don't read these stories ahead of time. At the end of the year, there's daily bookkeeping, and then there's end of quarter, end of year, where they need a certain amount to recapitalize. It depends on how much debt they've pushed out into the world, made in loans, as compared to their deposits, all right? So it makes sense last December that it's peaked. Will it go down in January? Yes, it will. But my point being is this: the Fed is in the middle of bailing out the banks. Okay, when the word repo comes out, when the Fed repo term comes out, the last time that it came out really in full swing was in 2009 to deal with the aftermath of the Lehman Brothers and all of the mortgage-backed securities crisis. Okay? So if you think that you're safe right now, you're not. Now, if you're getting ready to invest in the future, you may want to hold back a little bit and just watch, because I have a feeling there's going to be a little skirmish in the stock market and in the housing market here pretty soon. Now, it says the facility has been shrinking markedly in recent weeks as the Fed continues to draw down liquidity and other money market securities prove more attractive to investors relative to the 5.3% rate offered on reverse repos. Now, we're going to see, as the Fed tapers the amount that they're giving to these banks in liquidity, who's going to be swimming naked. Because as that water recedes, we're going to find out which banks truly need that. And we're going to start seeing news stories. I'll be reporting on that in the first and second quarters of this year. The New York Fed also reported Friday that there were zero inflows into its standing repo facility, which suggests any dislocations or liquidity needs in money markets were not substantial. Now, right here out of Reuters, another story. U.S. overnight funding rate hits record high. Oh, sorry. I just read that again. Boom, boom, boom. Next story, next story. All right, here we go. Wolf Street. This is about mortgage rates. Mortgage rates dropped a lot, but clearly not to the magic level. Buyer's strike continues. The issue is price. And this is what I've explained in my real estate crash course. In that one next phase, we're in the next phase where we have a blow off top led by a bunch of small buyers, a few buyers, where velocity collapses. And as it comes down, you've got a struggle between sellers dropping price and buyers sitting back and going, I'm not going to buy. And that's why you have golden handcuffs throughout America right now. And that's what people need to understand, how big of a deal this is, because there will be a concession. I can guarantee you this, the concession is coming. It's going to come in home prices dropping even further than they are. As a matter of fact, the media is trying so hard to spin this. They're trying so hard. You swear this was like the real estate was being run by Bill O'Reilly with the spin factor. You have all these cities around the country like Vegas, San Francisco, places in Utah, they're all over the country that are falling. There's a lot of them that are falling in double digits right now, right, throughout the year. But then they go to, like, look at Boston. Boston's hit an all-time high. Yeah, some moron bought a $800,000 condo. That's how they're justifying it. The lowest price homes are pushing the median price up a couple of $1,000s, a couple grand. Are you willing to bet a couple $1,000s that the real estate market's going to stay strong? This is what also blows me away. It's so fundamentally easy to figure out, but most people fail to get it. They say that real estate's not going to crash this time. This time. Every 7 to 10 years we go through a recession and houses stable off or they dip a little bit, depending on where you are in the country. This time it's different. Where are the higher wages coming from? You have companies that are already laying off people by droves just to be able to satisfy their shareholders. Where are the higher paying jobs coming from? Because I can guarantee you this, if you think for a second the government's going to go print it, that will create hyperinflation. And that's a bad thing. So it says the dream is, or was, that mortgage rates dropped enough in November and December to push potential home buyers out of their buyer's strike and to sally forth and start bidding wars all over again, so that we could amuse ourselves with headlines touting the new craze with millennials and Gen Zers are trampling over each other to outbid each other, to drive up prices, to make each other miserable, so that the sellers could maximize their gains. The media just loves touting that kind of stuff, and I couldn't say it better. And it says, and mortgage rates dropped a whole bunch. And new listings are now suddenly showing up in larger numbers. That's another part of the phase of the real estate crash, right? Inventory picking up. We have so much new inventory flooding the market. It's insane, especially with the new home builders. But buyers, not so much. Clearly, mortgage rates haven't dropped to the, to the magic level yet. Folks are waiting for them to drop further, and the market remains frozen. Pending home sales, a forward-looking indicator of sales of existing homes based on contract signings in November, were unchanged from October, and both occupy the second lowest historic low after the historic low in April 2020, when the whole world was locked down. And I was working at a real estate agency where we couldn't even show homes for a few weeks. And then the regulations and the signings and people wearing masks, I didn't even show homes. I'm like, well, I'm not wearing a mask, so I don't, guess I'm not showing a home. Good thing I make enough money doing other things. So, and it made me sick to watch that industry. But right now, that's how few homes are being sold. And there's no mask mandates. There's no documents that you have to sign to get into a house. That's where we are. This is, when you say terminal velocity, think about the stop, the part where you're at terminal velocity, you're at maximum, you're now at stop. You hit the ground, you're squished. That's it. So the only thing that's going to happen, because the Fed, even if they lowered 3 times by 25 basis points in 2024, they are only going to be able to bring a mortgage to, at the lowest, 5.5%. And that's if you have 20% down and stellar credit. So you tell me, where do you think the housing market's going? I think it's going into the toilet, and I'm going to be excited and waiting. And then what I'm going to do is I'm going to buy a ton of homes, and I'm going to do it on YouTube. Excuse me. Whoa, jeez. My point being is I'm going to do it all over the internet, and I'm going to do it not by myself, but I'm going to do it with you. So if you want to take advantage of that 80% off deal, I'm going to put some links down below. These are the last 2 days to get this at this price, and then it's it. We go running. And yes, I'm still putting new lessons on throughout the year. There's already over 35 videos on there right now. And through 2024, I'm going to be putting more lessons on there for you guys, so that you can keep getting this knowledge like a coaching session and keep getting excited, because times are going to change. And this little Fed fake out that's going to happen, where they're going to lower rates a little bit, it's all on purpose to suck some people in. Don't be fooled by it. But you'd have to be looking long-term like me. I'm looking out the next 2-3 years. And I got to be honest with you, I'm pretty excited. All right, with that being said, thank you to everybody who hit the subscribe button. This is not my normal channel. It's the backup channel. I do videos every day on it, and they're totally different. The Real Estate Ninja is out.